Although we will purchase anywhere from 25 to 35 common stocks for our portfolios, we follow 200 to 300 stocks basically all day long. And in effect, what we're doing is following stocks that have the potential to be inserted in our portfolio, but either they have not reached our target level, or we have other stocks in our portfolio that are still cheap on a relative basis. So yes, we follow many stocks, but we pick the 25 or 35 best to be inserted in our portfolio. As deep value bargain hunters, we look for common stocks that are dirt cheap. We are hunters of stocks that are trading below tangible book or net asset value. Having found those stocks, if perchance they have a dividend of anywhere from 2, 3, 4%, that is a bonus. And interestingly, if you find a stock like that that has incremental yield of 2, 3, 4% of dividends, that may push the return of the portfolio up from a third or fourth quartile into a second or first. So while we're not specifically looking for dividends and we're looking for dirt cheap stocks, if we find a stock that is both, we are quite pleased to purchase the stock. In our search for good valued common stocks, our discipline focuses on a 12 to 18 month holding period for a return of 50%. It doesn't mean we're going to hold on to a stock for 18 months, but that is our patient target period. Having said that, there are quite often times when a stock will move up very quickly to a 50% return, and we will sell it within a 2 to 3 month period. So there's no particular time or period to hold a stock. The discipline is, have things changed for us with the 50% return and the 12 to 18 month target to change our focus and to liquidate a security. Generally, we like to be fully invested, but we always like to have a little bit of cash in case a sudden opportunity comes up. For instance, if the stock market has a sudden decline and all stocks go down and you discover a stock that you would like to buy. So we always like to have a little bit of cash, 2 or 3%. We consider that to be fully invested. But there are times when we're absolutely fully invested, and in order to, as I believe, in order to buy something which is very cheap, we'll have to sell the most expensive of our cheapest stocks in our portfolio. It is a real discipline to do that. If we suddenly become concerned with a lot of the macro trends and we're attempting to raise some cash, we'll review our portfolio extensively and try to cull those stocks which are relatively expensive in terms of our cheapest stocks. So in other words, we will sell the most expensive of our cheapest stocks. For instance, if our target on the stock was $10 and the stock was at 9 or 9.5, we might forego the extra $0.50 potential capital gain to raise the cash that we need to have comfort if indeed we think that the market is due for a tumble. We will cobble together an investment portfolio of dirt cheap stocks. We tend not to deviate from our style. However, there are times when we might sell a stock which has not attained our targeted level due to the fact that either one, we see the market perhaps being a little overpriced, or two, we see something better. So there are times when we will sell the stock which has not yet achieved our level, but on balance, we're very disciplined, we're focused, and we will continue to buy toonies for loonies whenever we can.